Good morning and welcome to the webinar on entering future losses on piCalculator. My name is Andy Brown, the piCalculator trainer. So the purpose of this session is to show the range of different future loss types that can be entered into a claim and demonstrate how to enter these losses with examples of when they might be used. During this session, we will look at the specific range of general care earnings, equipment, lifetime, pension, accommodation and vehicle future losses. We'll be entering the relevant details for a loss including time and values, how calculations are displayed when produced from entering the loss details. I'll be editing key criteria which will amend existing calculations, for example, adding an impairment to a rest of life loss or early retirement. Creating scenarios for the claim to compare calculations where certain criteria has not yet been agreed, for example, potentially different calculation dates, and where to access further support for entering further future losses on piCalculator. Please note that where a future loss type is the same as a past loss, these will not be covered in detail in this webinar, as the past loss webinar recording, which is available on request, has provided a comprehensive view of these losses. At the end of the presentation, we will leave time for questions. If you have any questions during the session, please submit them via the chat section by selecting the instant messenger icon at the bottom left-hand side of the Skype meeting screen. Please ensure that you have given your name and company in any message sent to us if you haven't already provided this information when you came onto the webinar. Note that any messages sent to us via the chat option can be seen by all those viewing the webinar, and if you wish to send us a more private message, email us on piCalculator@verisk.com. We will be monitoring this email address during the webinar. If you have any audio or visual issues during the session, you can select the share screen icon at the bottom of the window, which will contain an attachment to help you resolve your issues. All webinars are recorded and will be distributed following the end of the session. If you want previous versions of webinars, please email us on piCalculator@verisk.com. So we will now start entering some losses, and I'll go across to the site. There we are. And what I've done before the session was to set up a claimant, this one here called future losses. And if you want a reminder of how to create a claimant on the platform, please refer to the Add New Claim video in our help section at the top of the screen. I'll explain more about these videos at the end of the webinar. So as I said in the introduction, I'm going to split the future losses into general, earnings, equipment, lifetime, pension, accommodation and vehicle. I will also provide a quick overview of care losses, which are covered in more details in the past loss webinar. So we'll start with general losses. Now, to start a loss, create a head of loss by going down to the future loss section, which we see here in the main view, and then click Add New Head of Loss. This will create a head of loss title, which we'll call accommodation. There we are. And add loss. Then, if required, add some narrative for this loss by selecting the pencil icon on the narrative line. This will take us into the narrative box. We can type, or indeed we can enter in some text. Such as this, so copy and then paste but we would suggest that you paste not by doing right-click paste, but by doing Control-V. And if you have entered any narrative into the loss, then select Save. So to enter a loss, we go down to Insert New Loss, and from the field that says Type, we can see that there are a number of general losses: general continuous, general one-off and general periodical. These are covered in the past loss webinar, so the one I shall concentrate on today is the general continuous but for loss. This is unique to future losses, and it could be used to explain additional rental costs as a result of the injury. So in the description we can enter additional rental costs, and in the loss ages fields we can leave the defaults as age of calculation for the start and rest of life for the end, but we can change those if necessary, and we'll look later on in other losses as how we can enter that information. So for the cost prior to injury for rental, we'll put in £1,200 a month, and then as a result of the loss, £1,600 per month, and then save and close to create the calculation. So the calculation is shown here as 4,800 but multiplied by the life multiplier. If we want to know how that's been created, if we were to go back to the overview, open up key facts and multipliers, our life multiplier is given here. Rest our cursor on the green circle at 55.03. That calculation has been done by taking table 2 from Ogden, because this is a female claimant, interpolating between 38 and 39 years, applying the minus 0.25% discount rate, and as I say, the multiplier is 55.03. So we'll go back to our loss of accommodation just to see the result of the calculation, which has come out at 264,144. So that's a very brief look at a general continuous but for loss. I'm now going to look at future care losses, and I said that I'll provide a brief overview of care losses available in future losses. First, we need to create a head of loss. An alternative way to create a future head of loss without having to go back to the main view is to choose future losses from the left hand menu and then select Add New Loss to bring up the head of loss title box, and in here we'll put future care and add loss. So to add a loss, we go to Insert New Loss, and from the drop down in the type field there are two care options, care and care split. The one that we'll choose is care split, and this might be used where amounts of care differ within a specified period. So in the description we put family care, and in the start of this loss we will have as the age at calculation. For the rate to use, we could specify our own rate, which will then ask for an hourly rate, or choose one of these rates, which are taken from the which are the NJC care rates that form the basis of facts and figures, and we'll choose aggregate rate. We can enter a discount for gratuitous care of 25%, and then where the loss count field shows, this is the number of periods we want to put into our loss. You can go between 1 and 30. We use the default of 3, which in fact is the one that I'll use today. So in entering the details, in the first box under description we'll put period 1, care report that you're working from might indicate that the periods of care could be in years or ages rather than specific dates. And you can use the shortcuts contained in this box to help you with that. D for day, W for week, M for month, or Y for year. So for instance, the report might say that the first period they expect to last for 5 years, plus 5Y goes in the period until field. And the amount of care expected would be 8 hours, and we'll say it's per day, but if you have a look here, other frequencies are possible, such as specific days of the week or weekend or whatever is required. The next box down we'll put period 2. Period 2 does not need a start date as it follows on immediately from the previous period. The report suggests that period 2 will be for 7 years. The care has risen to 12 hours per day. And then the final period, period 3. The default end of this period is rest of life, but in fact the report might suggest that this is not going to be the case, because maybe the family can no longer care for the individual after a certain date. So we'll put that in fact this will finish after 8 years, and the amount of care had risen to 15 hours per day. And then save and close. So the calculation is displayed like this. It's taken the care rate at the time of the calculation, which is £12.06, taken off the 25% discount for gratuitous care. The calculation obviously is taken at 5 years. So that calculation, 5 years times 8 times £9.04. The figure is 26,396. Again, there's a multiplier being created, and you can see here how the multiplier has been put together using table 28. And the calculation for that first line is 133,304, and so it continues further down the calculation. Final figure is shown here. So that was a brief overview of care, but there may be an alternative way of doing care losses using lifetime split, where a loss will increase in the period between date of calculation and expected end of life. So I'm going to do this as a different type of loss. I'm going to add a new section this time, and in the description for this loss, for the section, we're going to put in lifetime care costs and save. Insert new loss as we've done before, and choose lifetime split. And we're going to say increase costs is the description we want to have in this particular loss. Now, if we continue on to say that the loss starts at the age of calculation, and that again we'll have 3 periods in this. Period 1, we will say that maybe the cost is going to be continue for 10 years, 10 plus 10y. The value of this is £20,000 a year. In period 2, which we say is going to last for 5 years, we would expect, according to the report, the care cost to increase by 10%. So we can actually put that in as in the value field. And then in the final period, again, not going through to rest of life, because we expect that, in this case it will go through to rest of life, and we'll say that it increased by 15%. And then save and close. And the calculation will show the percentage increase for each of the periods. Again, there's an explanation into how the multiplier has been created, and so the calculations are shown here, and the final figure is around about 1.3 million. So what we want to do now, having done care, is do some future earnings losses. And so from our left hand menu we go add new loss and enter earnings in our description. So we now have our head of loss called earnings, and insert new loss, and go down to look at the fact that we've got a number of different earnings types: earnings, earnings ASHE, earnings award, and earnings split. Now the earnings and earnings ASHE losses are covered in the past loss webinar, and I will do a quick recap after we've looked at the two types that are specific to future losses. So the first of these is indeed earnings award. This could be used to enter a Smith versus Manchester or a Blamar award if they haven't been entered through general damages. So in the description we will actually put Smith versus Manchester, and all it's requiring is a value. So I'll put 35,000 in there and save and close. In the narrative, I could explain how the figure has been calculated. For example, 2.5 times salary. So that's the earnings award. I'm now going to do another earnings loss, which is earnings split. An earnings split could be entered where an earnings report suggests that the claimant might have had some promotions in what was left in their career had they not had the injury, and the loss will indicate what the different salaries might have been. So we'll do add new section and insert new loss, selecting earnings split. We will leave the loss at the start of the loss as the age at calculation. The calculations themselves can be done as either net, gross employed, or gross self-employed. If either of the gross options are chosen, deductions for tax and national insurance will be done to arrive at a net figure which will go forward to the calculation. But today I'll leave it as net. The loss count refers to the number of periods to be included. The default again is 3, but you can, as previous losses, go between 1 and 30. If a claimant is in a career that has many potential salary levels, for example the military or teaching, this could be very useful. Now when we've selected 3, because the report has indicated 2 potential promotions, so the first period would be from now until the first promotion, the second period would be first promotion to second promotion, and the third period from the second promotion through to the end, which would be in this case the default of until retirement. So let's enter the details in here. In fact, before we do that, I'll just show you where it says hide residual. Hide residual would be left like this if the individual was never going to work again. But if the report indicates that the individual has the capability of doing some work but at reduced capacity, then show residual can be selected. So we're going to put that first period in. We're going to start it with the position where they are now, the current job. So the period between now in their current job and the age of 45, although a number of years could be entered here or an actual date. Their earnings would have expected to have been, if they hadn't had the injury, £20,000 per year. But the report says they have the capacity to work at a job that would be earning them £10,000 a year. Then by the age of 45, they might have expected to have received their first promotion. And that would take them through to the age of 50, the projected salary would be 24,000, but we'll leave the residual at 10,000. Then at the age of 50, they would expect to have got their second promotion, which will take them through to retirement. 28,000 is the projected salary for that second promotion, and again we'll leave the residual amount at 10,000. When that information's been entered, we'll go save and close, and we will see our calculation comes out at just over 400,000. Now the way that's been calculated is shown here in the, I just need to scroll a little bit, there we go, in the black box when we rest on the green circle. So what we have is the apportionment for the period from 38.04, which is where we are now, to 45, because the period is 6.96 years. The minus 0.25 discount rate is used. There's interpolating between tables between 6 and 7 years within table 28. We're also seeing that there is a contingency factor applied here, and the resulting multiplier is 5.87. So the salary for those for that period is 20,000 multiplied by 5.87, and the figure is 117,400. You then have the mitigating amount, which is the 10,000. So that is multiplied by the multiplier, same multiplier, 5.87, and in the brackets, which makes it a negative calculation, we have the figure of 58,700. And so it works its way through when the first promotion was achieved and the second promotion taking them through to retirement, and we end up with the figure, as I say, at the bottom of just over 400,000. Now at this point, I want to show how it's possible to effect these calculations if information concerning the claimant's work situation changes. In the employment section at the top of the screen, we can see that the individual is currently working employed, both before the injury and as a result of the injury, and that they would be expected to be using the state retirement age, which in this case is 68. But the information that we've received suggests that because of the injury, they are now needing to retire early. So in the column, as a result of injury, where it says use state retirement age, we select specify retirement age and change 68 to 60, and then select change. And what we will see is that the calculation we did for split earnings has risen from 404,000 to 473,000, and obviously the reason for that is that there were 8 years of £10,000 that are no longer part of the residual calculation. So I was going to mention to you the other earnings losses. I'll just show you this in the field. You've got earnings and earnings ASHI, and they also can be used with a but-for amount and a residual amount as well. The ASHI calculation uses the data from the annual survey of hours and earnings, and is obviously very useful in claims for children where you want to enter potential earnings they might have had as an adult. Full details again of how to enter these losses can be found in the past loss webinar. So that's earnings. Let's now move on to another future loss, which in this case is going to be equipment. So the equipment loss can be used to show when a particular item needs replacing on a regular basis. And an example would be a wheelchair. So in our head of loss description, we'll put aids and equipment and add loss. Insert new loss, and in the loss type we choose equipment. For the description we'll enter wheelchair, and we might say in this case that the wheelchair is not needed until 10 years after our data calculation. So we'll put plus 10y in the start date field, but it will continue through to rest of life. The cost of the equipment is 4,500, and this wheelchair will need replacing every 5 years. We can put an insurance amount in of £100 and maintenance. These are annual figures. Save and close. Note that the number of wheelchairs that are expected are 9. Okay, so we've done an equipment loss. We're now going to do a lost years part of the claim, where the claimant would still be alive but has a reduced life expectancy as a result of the injury. So in the left hand menu we'd go add new loss and just put lost years and add loss, and insert new loss to bring up the edit loss box, choosing lost years as our loss type. And we get a warning message come up to say there is no impairment of life expectancy for this claimant, and if you try to add this loss it won't calculate a loss for you. So we'll just close down our loss and show how we would enter in an impairment. We go to the top of our key facts area to the section that says life expectancy and has a heart logo. And we can imagine that we have received a medical report with details about the impairment. Change life expectancy from standard to impaired, and then add the details of the impairment. So in this case, what we might say is that the person might live to the age of 70. So 70 goes in the first box, and we use the option live until. Or we could say actually the impairment itself means that the individual will live 10 years less than expected, so 10 years reduction from standard. Or again, they might only have 10 years left to live from either the date of the report or the date of the trial. The option I'm going to choose is years reduction from standard. In order to do this calculation, we need to make sure that we have the correct multiplier for the type of impairment that we've chosen. So for 10 years reduction from standard, the multiplier is to find the appropriate age in table 1 or 2. If they had only going to be living until the age of 70, or were only going to live for another 10 years, then the multiplier in use here would be the term certain table 28 multiplier. So I'm going to choose find appropriate age. The but for life expectancy relates to whether there was an impairment already for this claimant. There was not. Their life expectancy before we added this detail was standard. So it remains as standard, and the multiplier is find appropriate age. And select change. Now before we enter our lost years information, we need to go back to aids and equipment, because by making that change in the impairment, by adding that impairment, the number of our wheelchairs has dropped from 9 purchases to 7 purchases. So it's another example of making a change in the top key facts area has an effect on calculations that might already be in the claim. So we will now do our lost years claim. So insert new loss and choose lost years. And we can see here that our details have come up. We're not getting that warning message that we had previously. Now you can choose this loss to be either earnings or pension, obviously dependent on the impairment. In this case, because we've said it's 10 years less than expected, we don't need to put any earnings information in. But before we do, we need to make sure the loss count for earnings is set to 0. Otherwise, we'll get an error message come up. The loss, the values can be in net. And there's also a lost years rate in percentage. We've made the default 50. I'll leave it like that. I'll choose the pension tab. And when we're at the pension tab, we can select the number of pensions to be included. Again, the default is 3. and you can go between 1 and 29 in this case. I'll choose 1 and just enter the annual value. I won't put a lump sum in this time, and just do 10,000 and save and close. So the calculation is worked out because we entered in the loss rate, the loss year's rate of 50%. So the amount that goes into the calculation is 5,000. The multiplier is the but for the impairment multiplier of 55.03, which we've seen already, and then the current life multiplier, which is 43.77. So the difference is 11.26, and that's the calculation that's gone on, 5,000 multiplied by 11.26. I'll now move to another pension, or another loss. This time is around pension. So once again, we'll enter our add new loss and put pension as our head of loss and add loss. When we go to insert new loss this time and drop down the type field, we can see there are 2 pension options, what I call a straight pension loss and an early receipt pension loss. Today I'm just going to do the normal pension loss. If you are going to do an early receipt loss, it needs to be for a final pension scheme and should only be used for payments that have already been received. So let's choose pension. We can enter a description of the pension that we're putting in. In this case, we're going to call it a post office pension, but obviously you can, you might need to do, if there are more than one pension, you might need to enter different losses for the different pensions. The start and end date can be amended if required. And then we can enter the amount that they would have had, but for the injury, 15,000 per year. Again, you can have net or gross here. The residual, what they are now going to receive is 10,000 per year. Save and close. So the calculation shows the amount that would have been received against the amount that is now being received as a minus figure. So the total loss, and of course there the way that the multipliers have been calculated. And we can see that the actual calculation itself is the top figure minus the bottom figure. And the actual pension loss is 74,800. Right, we're going to go back to the accommodation head of loss that we created right at the start, because it might be that the loss involves a house purchase. And it is possible to do a Roberts v Johnston calculation should you wish. So I'll add a new section and give it a title of house purchase and save. We'll insert a new loss and select RVJ, Roberts v Johnston, as our loss type. We can change the start and finish dates as required, and in this case maybe we'll say that the accommodation is only required for 10 years as the remaining years will be spent in care. So plus 10Y as the end date for this loss. Now the cost of the required property we're going to say is 500,000. The existing property 300,000. The cost of adaptations we're putting as 15,000 and a betterment value of 10,000. Now at this point there's an issue around the discount rate. Using the discount rate of minus 0.25, I'm going to get a very poor return for the calculation. So I can choose my own discount rate by deselecting use discount rate field and putting in my own figure over here, which I'm going to put in as 2.5. And then I will add some increased running costs of £600. This is an annual figure. When I put that detail in, save and close. So the calculation will have the difference between the property required and the current property plus the betterment, which is 210,000. Applying the 2.5% RVJ value gives us 5,250, and add that to the increased running cost to give us a value of 5,850. If we rest our cursor on the green circle, again we get an explanation of how the multiplier that's going to be used in the calculation has been arrived at. And so therefore the calculation is worked out at 59,553. Adding to that is the difference between the adaptations and the betterment of 5,000, and we have a total loss that we're going to put into the claim of 64,553. Obviously we're expecting a judgment in relation to accommodation costs this year. Even when we need to make any changes to the platform as a result of that, we will make those changes. So the final future loss that I want to look at is a vehicle. So coming down on the left hand side and adding new loss and entering our head of loss title, which we'll call vehicle. And insert new loss. Choose vehicle as our loss type, which is the very bottom of our list. And again, deciding on our dates, we might decide exactly the same as we did with the accommodation. This loss is only for 10 years from the date of calculation. So plus 10y goes in the end date. The cost of the required vehicle we could put as 30,000. And the credit for the existing vehicle we'll say is 15,000. The replacement of this vehicle is every 3 years. The trade-in value we'll put as 5,000. And the increased insurance on an annual basis is £200, and running costs annually £300. Save and close to get our calculation, which is worked out as shows. So the first is 15,000, the difference between the two figures here, and then we've got the way the calculation of 3 purchases are required because we only wanted it for 10 years. And then we've got again showing you how the multiplier has been calculated using the minus 0.25% discount rate. Add those 3 figures together, you come out with 3.03. And again, we have a calculation here of how the multipliers are worked out for the insurance and the running costs. Add all those figures together and you get a final total which will go into the schedule of 95,840. So those are at the end of the losses that I wanted to show you in future losses, but I'd like now to suggest that we might want to view the calculations against different criteria to compare possible scenarios. Now our next webinar, which is at the end of March, will be focusing in detail on creating scenarios, but I thought I'd show you some simple ones to be looking at in relation to future losses. So first of all, we go to the overview. And in fact, when we do that, we will see that our losses, our schedule is now at a value of just under £3 million. So to create scenarios, and our scenarios can be anything really contained within the key facts area up here. We might have wanted to look at different discount rates or different liabilities. The one I'm going to look at today, though, is different calculation dates, because we don't know how long this case is going to take to settle. to reach a trial date. So to set up some scenarios, I'll go to the Manage Scenarios section here, and in the Claim Scenarios box, the green circle here says Add Scenario, which I'll do twice. You can have as many different scenarios as you like, but only 3 can display on the screen at any one time. The base scenario is the automatic title, the default title given to the calculations as we've done them already. And we can change that if we wish to, but I'm just going to leave it today as the base scenario. And then I'm going to provide 2 new titles for our first new scenario is +1 year, and the second is +2 years. In order to display the calculations on the screen, I need to make our columns active. So ticking the box next to where it says column 2 and column 3 releases the circles underneath. I'm going to say that the +1 year calculations are in column 2 and the +2 year calculations in column 3. When that's been done, select Save. So what's happening now is that the platform is creating 2 new scenarios to go alongside the original one that we had. There we are. Those are the 3 scenarios. But at the moment, they still have the same values. And that's because we need to make the change to the 2 new scenarios to get the calculations to be different. So we go to the +1 year column and make that the active column, which means it's highlighted in the green. Go to the calculation date and change that from today's date to 2021 and then select Change. And there you can see now the calculation is different to the base scenario one. If we go to the +2 year +2 years column and go into the calculation date and change that to 2022 and change, we now have 3 separate figures. I want to put it back to the original view that we had, so I'll do that by going to the management section over here on the left and manage scenarios and just moving my dots around. So column 1 has the base scenario figures, column 2 has the +1 year, column 3 has the +2 years. So we're back to where we were, but obviously with the relevant calculations for each of those new scenarios. In the key factors and multipliers, you can note that the multipliers reflect the new data, the new information that we've just put in. So there you can see, for instance, life multiplier is different with explanation provided. And if we scroll right down to our future losses, you can see at each head of loss, the calculations are different for each scenario. Right, so I'm now going to show you the help resources that we have. We had a brief look at this at the beginning. The video tutorials you'll see are YouTube clips, and we have one here on how to add future losses. If you cannot access YouTube, please let us know and we'll send alternative links to you. You can also see how to enter future losses by downloading the user guide here. This will show you how, in a step-by-step approach, how to enter losses. And you can also contact us through Redmark Help. You can telephone us, you can email us, you can send us a message in the system, and we'll be very happy to provide you with support. So that's the end of the formal part of the presentation. Just going to ask now whether there's any questions that have come through while we've been running the session. I'll just give you a chance to maybe just, there's none in there at the moment, but I'll just let you just enter in any questions that you might have. If any come in after we've finished, then don't worry, what we'll do is we will answer them on a personal level. That's absolutely fine. As I say, the next webinar we're going to be doing, we'll be looking in detail at different scenarios. We've made some changes to the platform in relation to scenarios, so there's a lot of ways in which you can do comparison of calculations on your screen should you wish to. But I'm going to say that we don't have any, because I haven't had any come in as we speak. But as I say, if you do have any questions, please get in touch with us. I'll just show us our the best way to contact us, piCalculator support@veris.com. And I'd like to thank you for coming on the webinar this morning. And I hope you have a good rest of the day, and maybe we'll see you again at the end of March for the webinar on advanced scenarios. Thank you very much. Bye-bye.